Hi, everyone. We will just wait a few seconds for more people to join, and we will come to you shortly. So good morning, good evening, everyone, ladies and gentlemen, wherever you are. I hope that you are staying safe and healthy during these difficult times. My name is Shayma Hassan, a Senior Proposition Manager within Islamic Finance team at Refinitiv. And today I will be moderating the session titled Beyond the Disruption, Where Oil Flow Next. So before we begin our session, I would like to give a background about the status quo and what's happening in the world. As coronavirus pandemic outbroke and it became a serious health fear and a significant disruption to the financial markets, its threat to be a universal economic pain become real. As you can see through our app from Icon Refinitiv of COVID vital macros, the total coronavirus cumulative cases reached more than 43 million around the world. And it was led by the US, Latin America, and European countries. In the front line, we have Italy and Spain. So that being said, severe measures have been taken by government and policymakers to mitigate the coronavirus risk and impact in the society. We saw around the world economies closing up, and we saw cities being locked down, airports being shut down, and restricted traveling were happening everywhere. Business and retail shops been closing around the world. The private sector been suffering enormously from the closing of the economy, and also we have even imposing curfews on the citizens around the world. With that, we can see that oil prices also dropping and fluctuating have also making the situation worse. The coronavirus shock became more hostile than the great financial crisis in 2007 and 2008. So with the financial markets dropping and with the supply chain being disrupted, the whole global economy has slowed down tremendously. We have recently received and saw the IMF forecast for the oil prices, and we are seeing that the oil prices now at $40 to $50 a barrel expectation for 2021. And it was advised to oil countries to diversify their energy mix given the oil prices stability, and there won't be any dramatic recovery for the oil at the recent time. So that being said, we come to our session today, Beyond the Disruption, where will oil flow next? We have in our agenda key topics that we will cover: economic conditions in Gulf and Middle East, what we expect post the COVID disruption. We will also discuss how the global oil markets are shaping up beyond the volatility and disruption brought by the COVID-19. We will cover also what are the latest updates from Opec and the physical oil landscape. And finally, we will cover what does this mean for the future investment and which key indicators will companies implement to govern their investment. So in our session, there will be myself, Shayma Hassan, the proposition manager within Refinitiv, and I will be moderating the session. I also have with me Yoyan Jong. He's a director at Oil Research and Forecast in Asia at Refinitiv, and also Ranjith Raja, the head of oil and shipping research MENA at Refinitiv. So before we kick in, I would like to just give some housekeeping instructions, how to use the webinar platform. Please submit your questions via the Q&A box, and we will answer them when we can during the webinar. Please use the toolbar at the bottom of the webinar screen to access the resources such as speaker biographies, webinar materials, technical support, and also we will have a survey to capture your thoughts and views on the discussion at the end. So at the bottom, if you click on any of the icons to open that window, click on it again to minimize it. So to start up with, I would like to welcome Yan-Jang Yon, our research expert in oil markets. He will cover the Asia perspective, the oil markets in COVID times, and how has each of the Asia major refining centers coped with the situation. The floor is yours, YC.
Hi, thanks. Thanks, Shaima. Hi, everybody. Welcome. Thanks for coming. So what I'm going to talk about is, as I said, how has each of Asia's major refining centers responded to the COVID crisis. But before we do that, let's just take a little snapshot of where we are insofar as the broader oil markets are concerned. Well, prices have now stabilized to around $40 a barrel. It's just over 40 today for Brent, after falling under $20 a barrel at 20-year low levels in April and May. And at that time, we also saw the US benchmark closing in negative territory for the first time ever. Since then, the OPEC Plus alliance has imposed the largest output cut in history at 9.7 million barrels per month for May through July, and that has been reduced to 7.7 million barrels per day from August until now. Demand appears to be returning. We see crude imports rising and refinery runs rebounding, particularly in China. Refining margins for jet fuel and gasoline, both of which fell into negative levels in April, have improved, and as demand for transportation fuels return while lockdowns are gradually eased all over the world. But we have also seen this recovery stall in the past 3 months. Demand loss overall globally is expected at about 9 million barrels per day by end 2020 versus 2019 levels. This is recovering from a loss of 29 million barrels per day at the end of April. Okay, so this is the big picture, and now let's look at the individual refining centers on a by-country basis. We start with China. Okay, so crude imports into China were at record high levels of above 11 million barrels per day from May through Sep, following large purchases of April to July loading cargoes. In a little bit more detail, China's crude imports hit consecutive all-time highs of 11.3 million barrels per day in May and nearly 13 million barrels per day in June, and held near these levels through July and August, before easing under 10 million barrels per day in September. And for October, we are seeing also around sort of 10-ish million barrels per day so far. This resulted from massive purchases of April, May loading cargoes when prices collapsed following the brief price war between Saudi Arabia and Russia in March. And this chart shows you the cargoes that's gone into China from a loading month perspective. And as you can see, April and May loading volumes exceeded 50 million tons for each month. That's a record high, versus the 2019 average of 37 million tons per month. And this was followed by over 40 million tons per month for the next 2 months, resulting in severe congestions that started in end May and has only just cleared this month. August liftings have since dropped to a 24-month low of 34.2 million tons, and October liftings are so far at about 32 million tons, the lowest since June 2019. So, as you can see, Chinese imports are starting to taper off. Okay, refinery runs are at record high levels because of the high crude imports, obviously, since June and through to September, with the operable capacity in the country expected to stay above 95% till end 2020. Okay, the high crude imports have translated into record high refinery runs of around 90% of capacity, the country's 15.59 million barrels per day capacity from June. well above the 5-year average of 79.6%, and rebounding very strongly from February's 5-year low of 72.1%. This was when the country was started to go into lockdown at that point of time. Okay, as you can see from the chart, China is running at well above average. Okay, and its operable capacity is expected to stay high at above 95% until end 2020, as it has been since July, while its runs versus its operable capacity is similarly high at over 90% since March. So this signals that the refiners will operate their plants at close to full tilt, barring unforeseen outages until the end of the year. And if you look at it from the perspective of yields and export, gas oil and gasoline are at around 5-year average levels from July, but jet remains poor. If you look in a little bit more detail, gas oil output surged to a 2.5-year high of 15.1 million tons for July, before falling back under the 5-year average of 14.7 million tons per month to a 4-month low of 13.2 million tons in September. Exports rose above the 2019 average of 1.7 million tons per month for the first time since May in September at 2.1 million tons. For gasoline, in contrast, the output stayed above the 5-year average of 11.1 million tons per month since July, culminating in September's post-outbreak high of 11.96 million tons, with exports rising above the 2019 average of 1.3 million tons per month for the first time since post-outbreak in the same month. Okay, however, jet output has stayed below the 5-year average of 3.6 million tons per month since March, coming close to that level in September, while net exports have remained below the 2019 average of 1.2 million tons per month, at only 500,000 tons per month since May. So in conclusion, we look at this, China, the sharp on-month fall in diesel output in August signals that the poor diesel market, poor margins in the diesel market has forced refiners to cut output of the product in favor of gasoline, which has better margins. However, unlike all the other refiners in other countries, China's refiners operate basis a government export quota for refined products at 56.03 million tons for 2020, which they need to maximize to be granted the same or higher quota next year. Up till September, China has only exported 32.15 million tons of gas oil, gasoline, and jet kero, or just 57.4% of the quota, meaning that exports will have to be ramped up in the last 3 months of the year. And this is expected to particularly pressure the already weak gas oil market, as output for the product accounts for the highest yield among China's refineries at an average of 25 to 30% of its yield, versus 20% for gasoline. In August, however, gasoline output exceeded gas oil for the first time in at least 5 years. So this is a signal that while the Chinese refiners have to export and they have to ramp up, they're still managing their gas oil output because of the poor international market. Okay, let's take a look at India. India's story is completely different in the sense that refinery runs have been at below 85% since April, and crude imports have been below average, under 4 million tons per month until September. India had been actually among the first Asian refiners to volunteer for extra cargoes when prices first crashed in early March, resulting in the second highest imports on record at 4.78 million barrels per day in April. And this is on the back of 4 months of near record high inflows of above 4.5 million tons. Less than 3 weeks later, the country was in full lockdown. Demand collapsed. Refiners were forced to shut capacities, bringing runs to a record low of 70% in April and staying under the 5-year average of 98% since, averaging at 78% post-outbreak from April to September. Likewise, crude imports plunged from May, staying under 3.7 million tons till September, under the 2019 average of 4.4 million tons per month, with the government having to actually put surplus arrivals into strategic storage, and they actually filled all 5.33 million tons of that capacity, while another 8.5 to 9 million tons were placed on board tankers to float mainly around the Middle East. Okay, yields for gas oil and gasoline in India remain under the 5-year average, and despite coming close to that level in July, while jet again remains well under. Gas oil output remains below the 5-year average of 8.9 million tons per month, hitting a post-outbreak high of 8.6 million tons per month for July before falling back under at 7.6 million tons in August. But it is a recovery from April's 5-year low of 6.7 million tons. Gasoline output similarly stayed under the 5-year average of 3.1 million tons per month, hitting a post-outbreak high of 2.9 million tons in July before sliding to 2.7 million tons in August. Jet kero hit a 5-year low of just over 550,000 tons in May before recovering to just over 700,000 tons in August. But this is way, way below the 5-year average of 1.65 million tons per month. Exports in India, both for gasoline and gas oil, average at pre-outbreak levels through April to September despite low runs, but jet output stayed below average. Okay, as you can see, gas oil exports average at 2.5 million tons per month post-outbreak, hit an all-time high of 3.4 million tons in April, amid low runs and below average output. This signals that domestic demand has yet to recover. The scenario for gasoline is similar, with exports averaging at 950,000 tons per month post-outbreak versus the 2019 average of 910,000 tons. Jet kero exports, however, stayed below average at 250,000 tons per month for April to September and fell to a 5-year low of 125,000 tons for August, signaling that aviation demand has yet to return in the country. In conclusion, for India, the around average exports for all three products amid low runs and below average output signals that domestic demand has yet to recover, in line with widespread COVID-19 infections through the country that has taken it to the unenviable position of number 2 in the world, with above 7 million cases. The sharply lower gas oil production in August signals that India's refiners cut runs to reduce output amid the poor margins, but it remains the product with the largest yield by far at 42 to 44% of total output, as it has been over the past 5 years. As you can see from the chart, India has not been able to reduce its gas oil output to below 42%. Indian refiners have also tried to keep gasoline output high because of stronger margins, but yields can only be at a maximum of 15%, as has been the case in the past 5 years. In contrast, they've managed to reduce jet output to 3 to 5% of the total yield versus the 5-year average of 7 to 8% for the 2015-19. So this reflects how poor the aviation market is in the country. All right, let's talk about South Korea. Again, the Korea scenario is very, very different, where refinery runs are actually at below average, under 90% post-outbreak, amid average crude imports at 2.7 million tons per month. As you can see here, crude inflows into South Korea average at nearly 2.7 million tons per month, April to September, just under the 15 to 19 average of 2.89 million tons per month, and hit a 14-month high of 3.1 million tons per month in April, when the country was in the midst of peak lockdown. Refinery runs stayed low post-outbreak, averaging at 86.9% April to September versus the 15 to 19 average of 97.6%, as domestic demand remains curbed by widespread second wave infections that has led to localized lockdowns. We actually believe that the high April crude inflows were made, a lot of it went into storage. About 600 to 700,000 barrels per day went into what we think are their commercial tanks as traders sought to cash in when prices were low at that time. Okay, however, yields of gas oil have actually held at 5-year average levels post-outbreak throughout the entire outbreak, although gasoline and jet stayed below average from March. Unlike other countries, South Korean refiners have kept gas oil output at steady levels versus the 5-year average of 3.94 million tons per month and averaging at 3.91 million tons per month post-outbreak from March to September. Gasoline output, however, remains below average till September, averaging at 1.15 million tons per month post-outbreak versus the 5-year average of 1.43 million tons per month. Similarly, jet carrier output also averaged at 1.65 million tons per month under the 5-year average of just over 2 million tons per month. And South Korea, to be noted, that is the largest producer of jet among Asia's 4 refining centers. South Korea's gas oil exports have averaged at pre-outbreak levels again through April to September, and gasoline and jet remains below average. Gas oil exports actually averaged at 2.28 million tons per month during the post-outbreak period, hitting a 14-month low of 1.92 million tons per month in May. And this is amid steady output and low runs, right? Unlike gas oil, gasoline exports have stayed below outbreak levels since April, averaging at 550,000 tons for April through September and hitting a 5-year low of 370,000 tons in May. Similarly, jet carrier exports stayed below average at 870,000 tons per month April through Sep and fell to a 7-year low of 625,000 tons in Sep, but remains largest exporter. Okay, the conclusion for South Korea is that, they are producing a lot more gas oil than anybody else, right? And producing at pre-outbreak levels, right? And we believe that that is because they actually, the South Korean refiners are enjoying better margins for the product than other refiners. Why is that so? If you look at it, from a yield perspective, the yield for gas oil is actually higher than the 5-year average. The gas oil yield today is like at above 37%, versus the 5-year average of 32.3%. And in contrast, yields for gasoline and jet carrier had been below 5-year average levels at 14.9% and 70.2% since April. We believe that this is because of the niche production of light cycle oil, or LCO, that has found favor among Chinese buyers, necessitating a higher output of middle distillates. With over 750,000 tons per month of LCO heading to China since June. Our October forecast is around 750,000 tons so far. Okay, Japan. Again, Japan is a very different story. Runs are the lowest among Asia's top 4 refining countries, under 70% since May, and crude imports are also at 5-year lows. Refinery runs fell to all-time low levels of under 60% from May through July, and despite a rebound in August, remained under 70% till mid this month, averaging at 64% post-outbreak, well below the 2015 to 19 average of 90%, since a declaration of emergency was made in the country in March. Similarly, crude imports also stayed low post-outbreak, averaging at 2.25 million barrels per day May to September, well below the 15 to 19 average of 3.19 million barrels per day, and hit an all-time low of 1.92 million barrels per day in June. Despite seeing some recovery from COVID-19, Japanese refiners have opted to keep runs low, to the extent of keeping operable capacity idle following a return from maintenance for most units by June. Okay, let's look at the operable capacity. It's rebounded above 80% from July, but its ratio to runs remain under 70%. Japan's operable capacity averaged at 86.4% from July to September, rising from 75.8% in April to June. That was during the peak maintenance period, though still well below the 15 to 19 average of 92.9%. So capacity returned in July. Yeah. However, with the return of this capacity post-maintenance, the ratio of runs to operable capacity fell below 80%, averaging at 71% for July to Sep, versus 84.4% April to June, and the 5-year average of 97.8%. This signals that refiners are deliberately keeping capacity idle, despite them being operable. Yields and export for diesel, gasoline, and jet kero are all at below average levels since February, turning into a net importer for gasoline since April. Gas oil output stayed at below the 5-year average of 2.9 million tonnes per month since January, averaging at 5-year lows of 2.23 million tonnes per month post-outbreak, leading to all-time low exports of under 150,000 tonnes in June. Japan imported an average of 140,000 tonnes per month of gasoline April to Sep, peaking at 230,000 tonnes in June. Output averaged at 2.49 million tonnes post-outbreak, well below the 5-year average of 3.24 million tonnes per month. Similarly, jet kero output averaged below the 5-year average of 2.06 million tonnes per month, averaging at just over 50% at 1.12 million tonnes per month post-outbreak, while net exports averaged at 340,000 tonnes April to August, under the 5-year average of 600,000 tonnes. So in conclusion, we see that the low runs to operable capacity ratio throughout the entire post-outbreak period remains low, signals that Japan's refiners are deliberately keeping runs low, to the point where they are willing to become net importers, as with the case with gasoline. In particular, percentage yields for jet kero have averaged sharply lower in April to September at 11.62% of runs, versus the 5-year average of 15.5%, and hit an all-time low of 9.7% in June. In contrast, yields for gasoline and gas oil remain close to 5-year average levels of 32.9% and 23.2% post-outbreak. This signals that Japan's refiners have actually adopted the strategy to minimize jet kero output due to the bleak outlook of aviation, even at the expense of gasoline and gas oil production. Okay, some final conclusions. Broad final conclusions across the markets. Just one snapshot of inventory. That the product market remains oversupplied, as reflected by high inventories in the Singapore trading hub for both middle and light distillates, with post-outbreak levels well below 2019 average and even Q1 2020 levels. Middle distillate stocks, for example, average at 14.4 million barrels since April, hitting a record high of 16.202 million barrels on September 6 and holding above 15 million barrels till October, well above the Q1 average of 11.3 million barrels and the 2019 average of 11.13 million barrels. So we have a lot of gas oil. Similarly, light distillate inventories average at 15.2 million barrels by mid-October versus the Q1 average of 13.4 million barrels and the 2019 average of 12.7 million barrels. Although it has since come off record high levels of 17 million barrels to around 13.5 million barrels now. Okay, from a product perspective, we are bearish crude, obviously, because Chinese demand has eased from September onwards and expected to fall further with seaborne liftings up till October falling to multi-month lows, while demand from Asia's three other refiners, India, Japan, and Korea, aren't expected to rise in a big way anytime soon, and expected to remain under average as the outbreak remains prevalent. Supplies have increased with rising output from OPEC Plus, which added 2 million barrels per day in August, and the US, which are restoring production amid the improved price environment, with output expected to be steady at 10.5 to 11 million barrels per day. And we have seen rig counts in the US increasing over the last 2-3 weeks. So we would expect to see an increase in US production, maybe to even above 11 million barrels per day, barring hurricane-related shutdowns. Crude's weakness is actually reflected in the forward curve structures of both the Brent and Dubai benchmarks, with their first to 12 month in contango, respectively at $2.30 a barrel and $2.70 a barrel, and with the front 2 months in contango since second half July. We are bearish gas oil too, even more bearish gas oil. Gas oil's refining margins, as reflected by the front month 10 ppm crack spreads to Dubai, have averaged under $4 a barrel since September, the lowest month average on record, and we believe can turn negative if current supply-demand fundamentals do not change. Diesel's forward curve structure has reverted to a contango of around $5 a barrel between the first and the 12th month, weakening from a backwardation in the front 3 months just 2 months ago, but still an improvement from the $13 contango that we saw in April-May. Diesel's cracks are even below levels seen in April and May, signaling that the oversupply has become severe, and as demand has yet insufficient to absorb these rising supplies. This is despite some refiners' best efforts to tweak output. But we believe that China will continue to export large volumes of gas oil. So, it doesn't look good. Gasoline was a little bit more bullish but turned bearish, with its refining margins as reflected by the front-month crack between 92 RON and crack, hitting a post-outbreak high of above $4 a barrel in September, but has since weakened to around $2 a barrel in October. But although they're still well above the negative levels that we saw in April. Gasoline's forward curve structure was in backwardation in the front 3 months in September, but has since reverted back to contango, save for a slight 5-cent backwardation in the front, and with the first to 12 month at a contango of $2 a barrel. Gasoline strength in September, in contrast to diesel's weakness, drew a glut of supplies from margin-starved refiners who sought to cash in by producing more at the expense of gas oil. So that actually quickly turned the gasoline market back into oversupply. And I mean, we've seen the cracks go down from $4 to $2 in a short 2 weeks. That tells you that there has been a lot of gasoline supply that went into the market during that period of time. And jet, Carol, obviously we are also bearish, as its refining margins reflected by the front month crack to Dubai steepened in contango in September, averaging at 94 cents, minus 94 cents a barrel in the lowest month average since April, but has since rebounded actually strongly in October to positive territory at $1.24 so far. Despite this, the product's forward curve structure between the first and 12th month remains at a contango of $6 a barrel, signaling fundamental weakness. An improvement in domestic air travel in China and the expectation of a colder than usual winter in Japan have perked demand, and that has turned the cracks positive. But since then, right, the cracks have come off a little bit from first half October's high, and now it's below $1 a barrel. So it remains to be seen whether the first half October levels are actually overbought. And with that, I thank you very much, and I shall hand you back to Shaima.
Thank you, I think this is very interesting insights that we have got from you, and I'm sure it added a lot of valuable background to everyone who joined us. So I would like to also encourage everyone, if they have any questions, to share with us in the Q&A, and we will address these questions at the end of the session. I would like now to welcome Ranjit Raja, who will be speaking out the OPEC supply perspective and share with us his views. The floor is yours, Raja.
Thanks, Shaima. Hello, everyone. Good afternoon and welcome again. So for this next part of the webinar, the coverage is going to be more towards the supply perspective, and specifically with more emphasis on OPEC, the production and the export levels, the US shale a little bit, to try and see how they have been reacting with respect to the recent events of especially the COVID impact, and roll together how they have been impacting the global supply, and also a little bit of an outlook into the short term. So to understand the OPEC's role in the current scenario, I think it is more important to kind of recap on what exactly the current agreement entails and how it compares to the announced cuts from the OPEC group as such. So the cuts from OPEC and OPEC Plus were planned in 3 different phases. The first phase was basically, which came into end by the end of July, was the largest cut in the history, which was a monumental effort of almost 9.7 million barrels per day. And currently, right now, we are in the phase 2 of the agreement, which started back in August and is expected to go till the end of this year, where a total production cut of about 7.7 million barrels per day has been agreed. And the third phase is eventually where the cut is going to be reduced further to about 5.8 million barrels per day. And as of now, it is expected to start from Jan 2021 and is expected to go all the way till April 2022. And what I would like to emphasize in this particular table is also to try and understand the importance of the baseline that has been used for the cuts that were agreed on, which is predominantly the numbers that were on the back of October 2018 levels, which in the first place in itself to start with was about 4.2 million barrels per day higher than what the Q1 levels were when the whole agreement was being put in place. So what does this mean? What this means is the first agreed 9.7 million barrels per day was basically split into about 6.1 million barrels per day from the OPEC group and about 3.6 million barrels per day from the OPEC Plus group, and which essentially translates to about 4 million barrels per day of a cut from the Q1 production levels. But eventually, because of the net difference between the baseline numbers and the actual levels, the net difference was just about 2 million barrels per day. And of course, adding on top of this, if we take about the overproduction and the non-compliance that were put into place during the first few months of the agreement, the kind of the net reduction that had an impact was significantly even lower. And of course, the demand destruction came into force after once COVID took the world by storm, and all the major consumers pretty much had a huge demand concern due to the lockdowns and due to the various cutbacks in the refinery runs and operations, like what Vaisi mentioned, and which essentially led to the major supply-demand imbalance that is still prevailing, and more importantly, also the storage shortfall that we encountered in Q2, which skewed the market predominantly. And in terms of the OPEC production levels, I think the first one to note is the numbers back in April that we saw, which was one single month in the last few years where there was no agreement that was in place. And we could see how swiftly some of the major producers were able to capitalize on it and start pushing their output to record levels. I think Saudi recorded almost 11.7 million barrels per day. And what this eventually showed the market was the amount of spare capacity and the amount of flexibility that all these major producers have in their capability to push and increase the volumes if a situation comes down to it. However, since the agreement has been put in place, the kingdom has, of course, scaled back considerably or significantly in terms of the cuts that they have taken back. And they have even they had even enforced some voluntary deeper cuts, which resulted in just about 7.5 million barrels per day in June. So just between April and June, we went from the highest OPEC output on record to almost the lowest on record, which was just about 22.35 million barrels per day. And of course, we had a couple of producers who were not in the best compliance levels that were seen, and so in order to compensate for it, they had agreed for overcompensating in the months starting from September, and those are currently in place. And which essentially, starting from May, the overall compliance levels for OPEC Plus has been found to be at about 96%. So the one member which is expected to significantly skew the whole supply effort or the production levels going forward is going to be Libya. And we all know that the country recently came out of the force majeures, and all the blockades have been recently removed. And they have also shown how swift and how quick they can be in terms of increasing their output. And they are expecting their output to reach almost a million barrel per day mark by the end of November. And of course, we will look a little bit more into detail for Libya in the further slides, but that is essentially to try and show how significant the volumes can be and how it might eventually force the group in order to extend the whole production level or the production agreements that have been put in place till the end of this year. So just sticking with the major producers here in the picture. So we are still talking about the three major producers, which is the Saudi, US, and Russia, and also the rest of OPEC taking into factor. The production cuts, along with a significant scale back from the US, may primarily due to the shutting down of rigs, or due to almost on the back of the price collapse that we saw, has had a huge impact in terms of the global production levels. And this dropped to almost about 70 million barrels per day back in June, and which is believed to be the lowest level since at least November 2003. And these three major producers contribute to almost 60% of the global production. And what this essentially means is that since the OPEC has been putting production cuts in place, the market share of all these major producers have also been going up and down. So in the last 3 to 4 years, the overall share of OPEC share has been lost by almost 5% globally. Although a bit inside the OPEC group itself, Saudi Arabia, to speak of, they have managed to keep their market share ranging between 12 to 13% throughout the entire period. So that shows the kind of impact and the kind of power that the kingdom holds in order to push their barrels and in order to make them as attractive to the primary demand centers that they would significantly see as the primary consumers. Whereas the US, on the other hand, they have enjoyed the major part of the last 3 years where the production cuts have been impacting the other major producers, whereas the market share of US grew from about 11% in 2016 all the way up to about 15.5% in March 2020. But that being said, they did have a steep drop recently, primarily after April, once the COVID impact came into force and the price impact or the price collapse resulted in several oil rigs being shutting down. And the small spike that we are seeing back in June was primarily because June was the time when we saw the overall global production also drop. And because of that, it shows us a slight increase in terms of the percentage or contribution of the US, but that doesn't necessarily mean an increase in the output from the country. So looking back, looking more into the US, a little bit more into detail, I think what has become quite evident for all of us right now is the lack of correlation that exists between the rig count and the production levels. So earlier, the rig count used to be a good indication of how the production capability of US used to be, but we believe that is no longer the case, and it is not an accurate indication of the capability of US production as such. So over the years, the efficiency of the rigs has been improved massively in order to sustain higher outputs, despite the rig counts falling significantly. And this was actually shown in the last 6 months that we have seen in the market itself. So the amount of, or rather the number of rig counts dropped by almost 75% in the last 6 months. But whereas if you actually see the corresponding production levels, it has dropped only by about 25%. And not to mention the number of the drilled but uncompleted rigs with the DUCs, that is that is currently existing as an available or a spare inventory, which can be quickly ramped up if needed. And of course, the prices need to be supportive for these inventories to be brought back online and brought back into pumping more oil. And like Vaisi mentioned earlier, the prices have been stabilizing and sustaining around the $40 mark, and which in itself is a significant level for the rig counts to have recovered. And that is exactly what we have seen since the mid of August, where the number of rig counts that reached an all-time low has actually started picking up, and they have increased by about 20% since the end of August. And switching from OPEC production into exports for going forward, I think it's important to understand how this has been impacted by the lower production levels as well. So the Middle East members of OPEC, they have been quite quick in terms of compensating any loss in volumes that have been seen from the African and the American members of the group. There are various factors that kicked into play due to the operational limitations, due to the geopolitical factors, due to force majeures that impacted several of these members. But the Middle East members have always been forthcoming in terms of compensating for any additional barrels that have been left on the table. So the Middle East accounts for about 64% of the OPEC volumes, or it accounted for 64% of the OPEC volumes back in 2018. That increased to about 68% in 2019, and they are currently, for 2020 year to date, they are roughly at about 75%. So this kind of shows the impact that the Middle East producers play in the global oil market. And as mentioned earlier, Saudi has been spearheading the campaign's effort with the record levels in April, and their exports average just about 6 million barrels per day since May. And Iraq has also been reported to be compensating for their overproduction for the first 3 months of the new agreement that was put in place. But their exports, their exports are also expected to take a hit in Q4 of this year, where they are expected to be overcompensating and complying for the agreement that has been put in place. And of course, apart from this, there are several geopolitical factors in place where the US sanctions on Iran and Venezuela have also significantly reduced the exports that have been going out of these countries, especially from Venezuela, where it hit a rock bottom back in June, where their output or their exports dropped to the lowest since 1943. And Libya, on the other hand, of course, we know they had struggled with the port closures and the internal strife for the last 8 months. And their output, although is expected to go up to almost 1 million barrels per day, their production to export ratio usually stands somewhere at about 80 to 85%. And that is going to be a significant jump from the exports that we saw back in August, which was just about 50,000 barrels per day. So looking at Libya a bit more into detail, I think this was as expected to be one of the major factors which was expected to swing the supply-demand balance significantly once they came back online. We do know that Libya is not part of the production cut agreement that has been put in place, which kind of removes any kind of a cap in terms of the output that the country can produce. And since lifting the force majeure, already the exports for October have increased to excess of almost 300,000 barrels per day, compared to about 50,000 barrels per day back in July and August that we saw earlier. So what we can expect going forward is that the NOC the national oil company has already announced that the production is expected to hit the million metric ton mark by end November, and which, considering the 2019 levels as a reference level, that means we can expect almost 1 million barrels per day to be put back into the supply side of the equation, especially from within OPEC, and which in turn is expected to have a significant policy discussions and decisions that needs to be made when the time comes for the transition from phase 2 of the deal to phase 3 of the deal, starting from Jan 2021. So more than 50% of the Libyan exports in terms of destination usually goes across the Mediterranean, which is mostly across the Mediterranean, followed by China, which accounts for about 16% of the output. So considering majority of the Libyan grades are usually the light sweet grade, so they are expected to be more of a competition to the African members of the OPEC group rather than the Middle East than the Middle East grades to speak of. So that is another equation that needs to be considered going forward. So since the African members have already been lost, or rather the decline in African production were predominantly on the back of Libya, and with that coming back in, we'll have to see how the whole market share within the OPEC group kind of changes in the coming 2 to 3 months. And talking about the destinations, it'll be interesting to look at how the OPEC's output is kind of completely focused or predominantly focused on Asia, which remains the primary choice, followed by the Mediterranean, then followed by North America, and then the UK and the Northwest Europe. So to put some perspective into numbers, then almost 95% of all OPEC exports eventually head to one of these top 4 or 5 regions. And amongst them, Asia alone accounts for a significant chunk, which we expect roughly about 60% for just the top 4 consumers, which, as YC covered, between China, India, Japan, and South Korea, they factor for almost 60% of the volumes, which pretty much leaves very little for the rest of the Asian markets and the global markets, where we look at purely from an OPEC's perspective. Sorry. So, and in order to determine how the changes are expected, I think the good indication is to look at what the 2019 levels have been, and that would act as a proxy in terms of what we can expect post the COVID timescale and when the demand is expected to come back online. And we have split the destinations from the OPEC members as the African members and the Middle East members, and how their destinations have been changing between 2019 and 2020. So it is quite clear that 2019 volumes are higher than the 2020 volumes, but how much of a percentage difference is what actually makes the difference. So if you look at it here, the Middle Eastern producers were able to manage with as little as about 6% change from the 2019 levels to 2020 levels, whereas the African members have dropped their volumes by almost 23% compared to 2019 levels. Likewise, I mentioned, China still remains the largest consumer, and they have been the only country who have been able to increase their consumption in 2020 compared to 2019, compared to what we have seen back in 2019 levels as well. And taking a quick breakdown into the Middle Eastern producers, the 2 of the major producers are Saudi Arabia and Iraq. And it is quite evident that Saudi has maintained their market share pretty flat from 2019 to 2020. There was almost just less than about 2% of a drop from 2019 levels, which is quite insignificant compared to the overall demand destruction that we have seen globally. And whereas Iraq, on the other hand, their volumes for 2020 have dropped about 10% compared to 2019 levels so far. And both the countries, of course, have had Asia as the primary choice or primary focus. And that has also been quite evident with the way they have been setting their OSPs for the last few months, which have been more favorable for the Asian customers, and also to keep their crude more focused and more interested for the Asian buyers for the crude. And as for the other 2 Middle Eastern grades, 2 Middle Eastern countries, which is primarily the UAE and Kuwait, UAE has been the only country in 2020 amongst the OPEC group where the 2020 volumes has been above the 2019 levels. It has been quite marginal, just about 2%, but it is still nonetheless slightly higher in 2020 than in 2019. Whereas Kuwait has held fairly steady, pretty much flat year on year between 2019 and 2020. So what we can expect going forward from these countries is not that much of a significant shift or a skew in terms of the volumes that they push into the market or the share that they take from the global demand centers, and we can expect pretty much a standard volume flow out of these producers from the OPEC group. So talking a little bit into the pricing element of it, I think the contango in the market is still existing, and which is basically pushing the volumes for more loadings than the actual demand that is prevailing. If you look at the M1, M6 time spread for Brent, it increased to almost $13 per barrel right at the peak of the price war back in April, and which eventually prompted several traders to kind of take advantage of the pricing and also book several and multiple cargoes at the same time. And that was the time when Q2, when we were expecting China to also slowly start recovering from the pandemic, and demand was expected to pick up at that point in time, which kind of resulted in a spree of bookings, tanker bookings, and spree of vessel loadings that we saw, and which eventually ended up in the Chinese coast, creating a massive backlog and congestion at the port. And of course, needless to say, there has been some recovery from April through June. And what is important to understand is also the second wave of pandemic that has been hitting the major demand centers right now. And hence the weakness in the market still does exist. And the little support that we have seen so far have pretty much been the weather-related issues back in the US, and that have helped sustain the prices to reasonable levels, or to at least at the resistance levels that we have seen by around the $40 per barrel mark. And what we have discussed is they have also helped in the slow resurgence to the US rig counts as well. So the overall, the momentum that was expected has not been able to counter the concerns that have prevailed in terms of the weakness on the fundamentals that we have seen in the market. So that kind of keeps a cap in terms of the recovery and the prices being pushed ahead. So, of course, obviously, the contango also helped in stockpiling, which was what was quite evident in terms of the storage that we see primarily in order to take advantage of the prices. YC covered quite a bit in detail in terms of the Asian market inventories and the stocks. So I'm just going to cover a quick update into the US market and the European markets. So the US crude inventories started to spike right at Q2. And primarily, they sustained well above their 5-year average. They have been sustaining through the year till date. And however, on the gasoline inventories, the lockdowns and the lack of travel within the country did cause the inventories to spike in the early part of the year. Although the refinery utilizations remaining quite low, had some relaxation to the regulation and the summer driving demand kind of helped the gasoline inventories to kind of come down. And it is now well within the 5-year range, 5-year average that we have seen. When we talk about the ARA, both the light and the middle distillate inventories are also in a similar state, with the economic lockdowns again causing concerns on the inventory. Causing the inventories to be much on the higher end. And with the second wave of the pandemic hitting the European market specifically quite heavily, the demand is expected to be lower, which will in turn continue to keep pushing their inventories at a much higher level. So going forward for the next few months, it is expected the inventory levels are expected to sustain at levels where we do expect to cater for the demand that will be coming in, which will eventually mean the refinery utilizations will remain suppressed. So quickly closing down with respect to the global floating storage, of course, we did see the floating storage spike back starting from April onwards. It almost doubled from April to June, when the volumes increased from about 65-70 million barrels to almost 140 million barrels. But although a majority of them, which almost about 80 to 90 million barrels, were positioned just off various locations between Singapore and China, and several tankers of Dalian and Qingdao Zhoushan, which primarily loaded on the back of the contango market that existed in Q2, had primarily reached the Chinese coast and were waiting for the cargoes to be offloaded. So that was kind of what, and since China released or eased the restrictions or opened up for the cargoes to be offloaded into the country, we saw a massive easing in terms of the storage barrels in Q3 as well. And same is the case with the middle distillates floating storage in Northwest Europe. The lack of demand and the excess supply saw the floating storage volumes reach almost about 3.5 million tons back in September. And they are expected to sustain around similar levels till the time we can see a considerable increase or a development in terms from the demand perspective. So finally, touching upon the freight part of it, we did see the demand of floating storage kind of had a huge spike in the VLCC tanker freights. The spike that we saw earlier in the year were due to several reasons. Back in October 2019, that was more due to the COSCO sanctions that was put in place. And back in March and April were more due to the contango market that was existing, which led to several multiple bookings of VLCCs, and which the price surged to by almost $200,000 to $250,000 per day. And especially since April, when all the major producers were shipping the maximum limits and no production agreement was in place. However, once the production agreement came into place, there was a severe curtailment in terms of the freight that which slowly started easing to a levels now where the vessel operators are just scraping by in terms of barely breaking even in terms of the daily cost or the time charter equivalent cost. And especially after the Chinese congestion has eased significantly, then that has also released several tonnage into the market, which is kind of competing for the limited cargoes that is available to be shipped right now. And that is kind of causing the primary, the freights to be suppressed at this point in time. A quick wrap up in terms of the summary for the near and for the medium term. I think the major factors are going to be more the cure for the virus, how that is going to impact in terms of the demand picking up again. the OPEC plus action and the shale reaction once we get out of the supply overhang and the demand destruction. Libyan output, we'll have to wait and see how they shape up for the next 2 to 3 months. The U.S. elections, which will play a huge role in terms of how the various sanctions amongst America, amongst Venezuela and Iran is going to be shaping up, and if there are going to be any policy decisions, although they might be more medium term than the short term. And in terms of the long term, of course, there is going to be the shift in terms of the EV vehicles, the demand, the consumption from the transportation sector, and also the policy decisions that has been taken by the various countries for the moving away from fossil fuel sector into more of the clean energy sector. So that's pretty much a wrap from my side. And I guess we're just about on time, maybe a few questions for back to Shaima.
Thank you, Ranjith. I think this presentation was very insightful for everyone who joined us, and we have a few questions coming from the audience. And you have mentioned the US election and how this will impact the market. And I think everyone is currently in suspense, waiting to see what will be the results of the US election. So that being said, we have a question on how will the US election impact the outlook of oil prices. I think, YC, you can just give us some feedback on this question?
Yeah, sure. Thanks. Well, I mean, the big question is who the impact would be depending on who wins it, right? If Trump wins it, then we would pretty much expect more of the same, in that they would encourage the U.S. production to encourage U.S. output, to encourage producers in the U.S. to produce more crude oil and export more, right? But if Biden were to win the election, then, we would expect limits on environmental limits on the shale drillers' ability to produce. I mean, and we would expect more, limits to be placed upon them from an environmental perspective, i.e. they cannot drill as freely as they would under a Republican or Trump government. In fact, Biden has gone as far as to say that he would take the U.S. to transition away from crude, right, into renewables, etc. And that is something that the US oil industry has not responded positively to. Yeah, back to you, Shaima.
Yes, thank you. I think that will be very interesting for us to see. We have another question from the audience. Can you talk about the evolution of spread between the ICE Brent and date Brent? In the last month, dated Brent widened its discount to ICE Brent, but now the FAR curve signal a spread close to zero on late 2022. So what is the reason for that?
Well, I mean, basically, if you look at crude production globally today, right, we're still basis the output cut, even in terms of real output, we're producing less than we were pre-COVID, right? But from an expectation perspective, OPEC Plus is expected to reduce these output cuts by another 2 million barrels per day come January. And that means the output cut at 5.7, 5.8 million barrels a day to last until the end of 2021, if I'm not mistaken. Ranjit, feel free to correct me here if you can. So from the perspective then, if at the same time, if we go forward and we expect demand to slowly return, right, from 2021 onwards, when you have the possibility of a vaccine coming in, you have possibility of lockdowns being lifted, in terms of infections being reduced, and even eventually slowly international air travel slowly coming back, then you expect demand to come back up to catch up with supply, right? And at that point of time, then if you look at it, then I would think that the far end of the curve do reflect these expectations. But of course, the caution is that there are a lot of ifs, right? If there is a vaccine, if lockdowns are lifted, if infections are reduced, etc. So it is a signal that the market believes that this will happen. But whether it will actually happen or not, everybody feel free to make their own call. Yeah. Back to you.
Okay. Ranjit, if you have any comments also to add?
No, nothing more than what Vaiti has already added. I mean, like you said, there's still a lot of ifs and buts that's prevailing in the market. So I guess the good sense of what we can get an understanding is primarily use what we have seen earlier as a pseudo range that we can expect to go forward as well. But yeah, I mean, I know there are still quite a few of them. But yeah, I mean, maybe we can answer everything in detail a little bit and then send it back to the audience as well.
Sure. I mean, we are running out of time, and if anyone has any question, feel free to come back to us, and we will get back to you after the session. It was a very insightful session, and it was a pleasure having you all. Thank you all for joining and for your time, and hope it was very useful for you. And hope to see you again in our future webinars. Thank you very much.
Right. Thank you, everybody. Thanks.
Thank you. Thanks, John.